The markets actually managed, tried to rally a little bit this morning to follow through with yesterday's rally on kind of this idea of a bit of relief after several days of declines. And we had talked about the fact in last weekend's newsletter, which is on the website now at realinvestmentadvice.com, that a retest of 2,800 would be very likely on Monday. That's exactly what happened. The markets bounced a little bit yesterday. That was encouraging coming off that support. But as I said yesterday on the show, that bounce was both narrow and weak in terms of volume. And today we tried to follow through with that a little bit, gave up the ghost pretty quickly this morning on back of really more concerns about tariffs and trade wars. The White House kind of ramping up the rhetoric along with China about a continuation of more tariffs, more tariff hikes and more taxes on products, goods, and services going across overseas. Speaking with Congressman Ted Poe in the last segment, he confirmed the same thing, that absolutely the White House is not going to back down on this. So tariff-related industries such as basic materials, industrials, as well as international and emerging markets, those still remain extreme. Actually, we have no exposure to those right now at all in portfolios, but remain very underweight those sectors now because those are the most exposed to this. Once we get past this whole tariff issue and once we sort it out, there'll be some opportunities there, but it's probably a bit early right now to try to be taking on too much aggressive exposure in those areas because of the fact that so much of this tariff battle that's going on is simply unknown. Last week, there was a bit of exuberance over the fact that Donald Trump cut a deal with, what's his name, Juncker?
Juncker. Jean-Claude Juncker.
Exactly. But that he cut a deal with him and there'd be no tariffs. That's not actually what happened at all. Basically, all that happened with the European Union is simply, hey, you don't go back and talk to my guys, you talk to your guys, and we just won't put any more tariffs on right now. But all the existing tariffs remain in place. And more importantly, whatever deal was cut with Juncker and, of course, on the tariff issue only reset the table back to where we were before the tariffs were put on to begin with. So we really didn't solve much except solve a problem that was created by the White House itself. So again, this all is already starting to weigh in on a lot of corporate earnings. If you're taking a look at some of these corporate earnings, listen to what these CEOs are saying. They're already talking about higher commodity costs. They're talking about higher tariff costs, steel costs, etc. That's impacting their business. That's also going through to profitability on their bottom line. And if they can't pass that on to the consumer, then it becomes problematic for keeping profits elevated. One of the things we're going to talk about tonight on the show is this idea of share buybacks. We've had a record level of share buybacks since the passage of the Tax Cut Tax Reform Bill. All that money went exactly where we told you it'd go, not to wages, but it actually went to these share buybacks and, of course, dividends and executive compensation. That's where it all went to. Interesting article about that today that we're going to discuss on the show tonight by Annie Lowry over at The Atlantic. So we'll get into that story a bit and go through that. Let's go through the markets here real quick where we are technically. If you're watching our live stream right now at realinvestmentadvice.com, just click on the live video link. You can see our video here. Where we are currently remains exactly where we've been. The recent resistance at all-time highs remains to be the case. Support continues right along this level at 2740. We just remain trapped within this range, really. And the good news is that we have been establishing a pattern of rising bottoms and higher highs. So that's bullish from the standpoint that the market is trending higher. Unfortunately, though, a lot of this oversold condition that we developed earlier this year from the sell-off has primarily been used, and yet we have failed to establish new highs. That's concerning, particularly as we move into September and October. As I said earlier, these earnings that we're seeing now, look, this is the market action since the beginning of this year, and this is with two stellar quarters of outstanding, record levels of earnings growth, and this is kind of all you got for it. Like I've had record levels of earning, and all I got was a T-shirt, right? That's all that's happened here right now. That's a little bit concerning here that the markets haven't been able to really benefit and really take advantage of those earnings to grow prices here. because as we move in the third and fourth quarter of this year, as I've been saying, we're going to start seeing year-over-year comparisons becoming much more difficult for earnings. And with this impact potentially of weaker economic growth in the third and fourth quarter, as well as potentially more tariffs and tariff situations, etc., that could bring in a lot more pressure on earnings than is currently expected. So we want to keep a watch on that because, again, while we've got portfolios are exposed right now, and we are carrying a bit of equity exposure because this market is rallying positively, but we are still watching our risk here very, very carefully. Now, moving on to a weekly basis here, this is really kind of the big picture looking back. It's the same exact look. Again, a failure here to make any type of new highs, wrestling with resistance here back from the beginning of this year. That continues to be very much the same story, really across the board, whether it's on a daily basis or a weekly basis. Support here at 2710, 2720 on the S&P is critical. If we wind up breaking below that support, we're going to have a much bigger decline in the markets to deal with, and that's something that could very well happen towards the end of this year or first part of next year, particularly if I'm right and we start to see much weaker rates of economic growth. And that's very much going to come from the fact that we're tightening monetary policy. Fed's raising interest rates. That, as we said earlier in the show, higher interest rates lead to higher borrowing costs. We're already seeing a negative impact from higher interest rates and the housing market in terms of starts as well as existing home sales. We're already seeing it in the auto sector. These are big ticket items, so they show up first. This is where people really cut back very quickly. I don't have to buy a house today and I don't have to buy a car today. But the more interest rates go up, we're going to start seeing deterioration in terms of credit card defaults, delinquency rates, etc. Pay attention to that data because that pretty much leads downturns in the economy. We've got a chart coming out on Wednesday that despite the fact that we've had supposedly all this great economic growth, personal consumption expenditures, which drives basically 70% of the economy, has actually gone nowhere. And is actually at a lower level than it was last year. So we're seeing weaker rates of personal consumption expenditure, not surprising with higher interest rates. Again, that leads right into those economic growth numbers. And economic growth tracks PCE very, very closely. So we'll be, that article will be out on Friday with our reading list. Tomorrow, we're going to be talking about that 4.1% GDP number. It's going to be on the website in the morning. Get it by the website, realinvestmentadvice.com. While you're there, subscribe for our newsletter. It goes out every weekend with our 401k plan manager. And if you need help with your portfolios, don't hesitate. Send us questions, schedule an appointment. Myself, John, Richard, we're all happy to help you any way we can. It's right there at the website, realinvestmentadvice.com.